Right, good afternoon, everyone. As I say, we're just giving it a couple of more minutes to let everyone, or let a few more people join us for today's webinar. But let's get underway, and I'm sure others can join as we go along. Well, thanks for coming. Obviously, the webinar today with Portex Markets is understanding candlestick patterns. So right from the very basics, looking at a few different patterns to identify, and going from there. My name's Ken Maxwell. I'm one of the senior brokers here with Portex Markets. We do these every Wednesday. I tend to keep them fairly brief so everyone can do it during the day or through their lunch hour, etc. So yeah, we'll get started. One of the points that I do want to do is, instead of rather than just doing basic slides and showing you sort of static pictures, I tend to prefer to actually bring in a live platform, my platform, my charts, so I can kind of show you it a bit more in sort of live form. So I think that's a little bit more interesting, a little bit more interactive for everyone, rather than, as I say, just sort of static slides. So let me just bring up the first one. It's just going to give you an idea of some of the points that we're going to cover. Obviously, it's saying what are candlestick charts, what are the patterns, types of patterns, etc. Why are we using candlestick patterns in your trading? As I say, rather than sort of going through those one by one, I think they're all, pretty closely aligned. So we'll cover those all in some form when I'm talking through this. If there's anything that you felt that we didn't cover that you'd like to hear more about, or a bit more in depth, then please feel free to get in touch either through over the phone, which you can find the contact details on the main website, or alternatively you can send an email to support@portexmarkets.com and someone will come back to you as soon as possible. So today what we're looking at is, as I say, we know candlesticks and candlestick patterns. Why are candlesticks important for our trading, whether it be Forex, which we're primarily focusing on today, or indices, or even equities. They are crucial. Understanding your candlestick patterns for your charts is absolutely crucial. It is the basics of looking at your trading. But it is important to know that you can't purely trade off candlesticks. There's a lot of other technicals out there that you need to focus on, economic data, etc. That is important, but it is the basics. And if you can understand what the candlesticks are showing you, then that's the starting point, and then you can build your knowledge and everything else from there. So let's, as I mentioned, I'd rather just drag in my own platform so you can see that, which I'll do in just a moment, and I can show you some examples of the different candlesticks that we're going to be looking at. Hopefully you can now see in front of us the MT4 platform, which we use here at Portex. I've got four different standard setup for the MT4 is the four different charts that you've got there. This top left one I want to use. I've changed the colouring format, etc., just to make it a little bit easier for everyone to see, rather than the green and black that you can probably see on the other ones. So if we start off, I'll just maximise this top left one. This is actually looking at pound dollar, so it's looking at cable, and it's on a 1 hour chart at the moment. I tend to work off 30-minute chart. People, some work off tighter time frames than that, but 30 minutes I think will do for us today for some examples. So as we can see, from this chart in front of us, we've got a series of candlesticks. And each one of these, just to mention to start with, when you do change the time frame on your chart, each one of those candlesticks represents that time frame. So in this case, each of those candlesticks is 30 minutes from open to close. and then the next one is the next 30 minutes. If you change that to a 5-minute, then obviously those candlesticks will change to that time frame instead. Now, what we're looking at is we've got really, two, as we can see, I've got the blue and the red, different colors for the candlesticks there. I've chosen blue, some people may have green, but really what these are showing is bullish and bearish candles. Now, in their most basic form, if hopefully you can see my mouse on the screen here, if we look at one of these blue candles here, that is depicting a bullish candle. Just for the time being, ignore the extension past that blue body, and we'll just cover what that is in a moment. But if we look at that, what it's basically saying in that blue candle there is the price of that, or in this case cable, has gone from the opening price, which is at the bottom of that main blue section, and it's closed at the top of that main blue section. So therefore we're seeing a bullish move. So buyers have come in, pushed the price higher, and it's closed at a higher price within that 30-minute period. And opposite to that, we can see if we just look to the right hand side, there's a small red candle there. The opposite to that would be that the opening price started at the top, and then over that 30-minute period closed at the bottom of that main red section. So that is in essence showing you the buyers or the sellers there on that particular time frame on that particular product or currency. Now, what we also need to look at, and that's, you will see some of those candles as an example, but more often than not, or 99 times out of 100, you will see what we can see here is there's an extension past these small thin lines past that main candlestick, the main body, and the colors that you can see, the blue and the red, that is defined as the real body of the candle. Okay, these extensions past these are referred to as I refer to them as tails, but other people might use the terms wicks or even shadows. And what effectively that is it means that from the opening price, the actual price during that 30-minute period, it may have extended quite considerably past where it opened and closed. But what we can see is there may have been a lot more buying and selling within that period, but actually when it came to the closing time of that 30-minute period, it reversed back closer to where it started. So if we're looking at that red candle, which hopefully you can see with my mouse here, we see there's quite a big extension lower, and then it comes back up to a nearer closing price, but still lower than where it opened, so therefore we've got a bearish candle there. What you will also, so that, as I say, that's really what you're looking at, primarily the main or the real body, but you will have all these extensions off of there as well. What we also have is doji candles. Now, doji candles are really where the price of the candle, or the price during that period, has opened and closed at the same or very near to the same price. So there's next to no body. If I just have a look, I'm sure we can find a few. Okay, there's a couple there. Hopefully again you can see my screen with the mouse. We've got two examples of doji candles here in front of us there. So we can see that there's been quite a large tail or wick, as some people refer to, and it's opened and closed either side, and it's come back pretty much to where it started with the open and close price. Now, doji candles can be seen as a bit of market indecision a lot of the time, and some people will see a doji candle as a reversal in sentiment or direction. But effectively it means where there may be quite a bit of buying and selling, the bulls and the bears haven't really managed to win either way, and we've seen it reverse, and therefore no one's really in control, so there may be a bit of indecision. Or as we say, if there's, say it was during a consistent sort of downtrend, so if we'd had quite a consistent low, and I suppose we could use this as a basic example here. We can see we've got a series of lower candles, or sorry, negative bearish candles here, depicted by the red as we go down. We then find a doji to a certain degree down here. It's not perfect for this example, but it will do just at the moment. We then see a slightly longer tail towards the bottom, as there's a bit of indecision after this sell-off, and then we start to see the price bounce back higher from there. So yeah, dojis are seen. You'll see a lot of these, and you know they're throughout the chart, as well, no doubt you can identify along the way here, but they are seen as either indecision, or tends to, some analysts will use it as a sign of reversal. So what we also want to look at now is just some patterns that you might find useful for your trading. The first ones I want to look at are pin bars. Now these can be either bearish or bullish, and let me just find an example of this. If we look for, say, a bearish to start with, see if I can locate something that is useful. Let's have a look. Okay, so this will do here, 6th of June, 6:30ish. We've got this blue candle here with a long tail extending to the top, and this is obviously what we're looking at to identify a pin bar. Is, or in this case a bearish pin bar, is we're looking for after a period of upward movement. So as we can see from this chart here, we've had a series of movement upwards with some of these blue candles, up to this point here where we've got a small blue candle, real body there, with a long extension on the tail. Now this is showing that we would expect a bearish move from here, and the reason being is, and how you identify a pin bar or a bearish pin bar, is the tail has to be at least, well, in my opinion, at least 2/3 of the actual real body. So it has to be 2/3 longer. And as we can see in this particular example, which is not a bad one, in fact, we've got a small real body there, and certainly over 2/3, and quite a bit more on the tail or the wick there. But what it effectively means is that, and the reason it's bearish, is we've seen upward movement from these blue candles, and then we've got to a certain point, and the price has extended quite a bit higher. There's obviously been the bulls have been there to try and buy into it on that direction, but what's actually happened is the price has then closed back down pretty close to its opening price. And what that means is, or what could be read as or interpreted as, is that a lot of sellers have started to come in at that sort of price. So you know, it was going up, and then there's been a lot of selling momentum, a lot of bears coming in, which then may suggest that the bears are looking to take control of that move. And as we can see in this particular case, which is not a bad one, we can then see after that bullish candlestick there, we start to see the price then move lower, and it moves quite a bit lower down to these levels here. So that's, as I say, called a bearish pin bar. If we look for, let's see if we can just find the opposite, just to show as an example of a bullish pin bar, so the opposite to that. One moment. Okay, we could use this as an example. In fact, here again, hopefully you can see my mouse there. 26th of May, around about 2:30ish. We've got. It's not perfect, but it'll do. There's a red candle there, so we've seen from the chart here, we've seen quite a sizable downwards move in the market there, with a lot of red candles moving down to this price here towards the bottom. We've then got a smallish real body of a bearish candle there, the red candle there, and we can see this tail which extends. Might not be exactly 2/3 more, but it's pretty close to, and we'll do just for this example here. So again, what we've seen is the sellers have been in control. The price then extends quite a bit lower, and then it closes closer to the opening price, or quite a bit closer to the opening price. So again, suggesting that the buyers are now coming in at these levels because we have seen quite a downward move, and they're looking to take control potentially and move the price back up. And in this instance, obviously we can see the price has then continued back up along the way. So that's an example of a bullish pin bar in this case. What we'll also look at is bullish piercing patterns. Now this might be a little bit harder to find, but I'll just have a quick look. Okay, I'm just having a quick look to see if I can find an example of these. Bear with me one moment. 5th of June. Okay, yeah, we could use this example. This will do here. 5th of June, bullish piercing pattern. So effectively, what that is where we've seen a downward move, but the next candle. So if we look at this, we've got the red candle here, the bearish candle here. We've then seen. Actually, that's not a perfect one, to be honest with you. But effectively, what a bullish piercing pattern would be is that the next candle gaps down due to strong selling pressure, and then we see the price then close higher, or pretty much at least halfway up the previous candle. So if we were using this as an example, we see the open price on this candle here, it does gap down from the previous close, and then it finishes pretty much up to where the close of the candle previous, or the open of the previous candle started. So what's happened there is there's been a lot of selling pressure, and then a lot of buying influx at those levels has come in, so therefore the direction would be expected to change to the upside. So as I say, we can see this is opened quite a bit lower from the previous close, and then it's finished up higher. So the buyers have pushed that currency, or that equity, back up above, and look to be taking control from there. And obviously with the opposite, if we saw the price gap higher on the open from the previous closed price, and finish higher than the previous open price, or at least halfway up, then again that would suggest that the sellers are coming into play at those prices after quite a bit of buying pressure. So therefore we could expect the opposite from what we're seeing just there. The last one, which I'd probably just mention, is a bullish, and it could be tricky just to find one, but off the top of the hat, but what would be is a bullish engulfing pattern, or a bearish engulfing pattern, obviously being the opposite. Let me just have a quick scan, see if I can see one sort of example for us. Let's have a look. This isn't a great example for us, but just for this purpose it'll do. Effectively, for a bullish engulfing pattern, what we're looking for is the last candlestick to basically engulf the previous 4 or 5 candlesticks. So if we did use this as an example, and I say it's not great because it only moves slightly higher from there, but this particular one's actually just prior to the UK election, so there could have been other factors to play in this movement, rather than if there was no news coming out of that significance. But if we look at this blue candle here, we can see 1, 2, 3, 4, and pretty much 5 previous candles which were red, or certainly lower. What's happened is the buying pressure's come in, and it's gone higher than those previous 5 candles, or those bearish candles. So it's basically, as it sounds, it's engulfing the prices of those previous candles, which would then suggest that the market could move higher from there, because the buyers are showing quite a bit of support. So, and obviously in the opposite direction, if we saw a bearish candle formed, which was encompassed or more than the previous 5 candles, say green or blue candles, then we could look at that as a bearish engulfing pattern on the other side. So really, from what we've looked at there, those are just 3 very basic forms of the candlesticks that you can look at. There are dozens, lots of different ones, different types of Dojis that you can look at, and people will read those in different forms. The ones we've covered, obviously there is, just to recap, are bearish and bullish pin bars, which again, with those, you need to remember that if you're looking at those, the wick or the tail needs to be pretty much 2/3 of the real body to then identify either an influx of buyers or sellers coming in at a certain price, which could then change the direction depending on which way you're looking at it, and therefore looking for a different move there or a change of trend. The other part was the bullish piercing pattern, which again, remember, is the opening price gapping lower than the previous close, and then going either 50% or even higher up that previous candle to show that it could be a change of direction, and then the buying momentum or the selling momentum is changing. And finally then the bullish engulfing pattern, which was the final one we just mentioned there, which is looking at the previous 5 candles in one direction, whether they be bearish, and then we're looking for the next candlestick to engulf or be encompass all of those within its body, showing a bullish engulfing pattern in that sense, or a bearish if we're looking at the other side. So as I say, those are the just 3 patterns that you can look out for. As I say, there's lots more of them, and obviously we don't have time to cover multiple ones of those, because the webinar is only about 25 minutes long or 20 minutes long. So those are the ones there, and obviously right at the beginning, really at the basics, you've got your bullish and your bearish candlesticks, so your green or your blue or your reds, and those tails or wicks, as others will call them, they will show the full price range within that time period, but it's the real body that you're focusing on for whether it's bearish or bullish, because that's where you've got your open and close price within that time frame. So as I say, in a sort of a very small way, those are just some of the basics. I'll take my platform off now. Those are just some of the basics for candlesticks and understanding those to get started with. But as I mentioned, candlesticks are crucial to understand your charts and make trading decisions. But you really, you need more. There's other things that you have to take into account, other technicals, and of course news flow. And as we saw on that particular chart, in fact, how news flow can dramatically affect the prices, even with patterns. If I just bring my chart back on, we saw a significant move lower for sterling there, as we can see, dramatically low, when we had the UK election the other week. So news flow is crucial. Keep up to date on that when you're looking at your charts, because it does have a big impact on your trading, and it can change your technicals quite considerably. So that's really that's it for today, guys. Thanks very much for everyone for attending. As I mentioned, there's a lot more to look at for candlesticks and understanding them. If anyone would like more information, or even to talk further on it in a bit more time, then please get in touch through the support at portexmarkets.com email, or alternatively you can find contact details on the main website, which somebody would be delighted to speak to you further. But that's it for today, guys. Thanks for joining, and best of luck with your trading for today.